You want? Do you want to add anything? Are you good? Okay, and another thing that luckily this mistake we've never made with over leveraging with the one thing that comes to mind with over leveraging that we see a lot, which we learn from other people's mistakes, is the second one. I know I'm skipping around, but stripping equity from your property. It is good, doing the Burr method and pulling equity out and buying other properties, but we've time and time again seen people getting in trouble because they stripped all the equity of the property, and then they were upside down on the property. And then when the market changes or shifts, or you need to sell that property, you're in over what the property value is. And, there's been people out there that will strip the equity to buy other ones to do like short-term rentals or mid-term rentals. And then they're in trouble because they have to, pay that monthly bill, or, pay back the either their loan or their money lender, and they're upside down because unfortunately a lot of the short and midterm rentals have not as much the midterm, but especially the short term has faded away, or they're not legal anymore in that place, or different seasons they didn't account for. It's being hot seasons, and then seasons where, especially up north, like in the cold, nobody's traveling, so there's going to be downtime and the time where your units are not going to be rented, and people didn't account for that, over leverage the house, so they're in all kinds of trouble trying to jockey around and try to figure out what to do. And just like taking on too much debt in general, you would be real careful how you finance your properties, and it could really lead to strain. And don't over leverage or take on too much debt where you can't pay it back. And cash flow analysis, you want to make sure that your rental income can comfortably cover the mortgage payments as well as other expenses, because the expenses are always going to continue to increase. And people, over leverage their rentals where they don't have reserves or room to add reserves, where, oftentimes people will have an account and they'll just, take the rent money and put a percentage of those into account as for repairs, renovations, and maintenance problems, things that arise. And there's a lot of renters out there that do not have the reserves. And then be careful with your debt to income ratio, and you want to maintain a healthy one to avoid overextending your finances. That way you can go out and get loans more easily. And make sure, your rental numbers do make sense. Make sure you look at all the numbers and figure it out, with an err on the side of caution. Always add extra to your bottom line. You have anything? And not properly evaluating the property, knowing your ARV, understanding your ARV, practicing that. Jane and I, when we first started getting involved in real estate, we didn't know anything about real estate investing. So we just did a lot of studying and looking at different houses in different areas, and just practice figuring out the after repair value, the rehab costs, the market rents in the area, and that sort of thing. Because it's, you have to really, somebody's coming in. I don't know. Okay. Whoops. You have to have your numbers squared away. And we started out wholesaling. So if we didn't have our numbers properly vetted, and we tried to sell that property to an investor, and the ARV wasn't right and the rehab cost wasn't right, we would have been out of business before we started. If the wholesalers, if you're not a good wholesaler and you don't put out good quality product, they'll just take you off your lists. So we went and talked to realtors, contractors, GCs, and just picked their brain, walked through houses with them, just to, get a, understand the rehab costs, the after repair value, the accurate market rents in the area. And we have systems that we use. Jane and I really like PropStream. It costs, a monthly fee, but it's well worth it. PropStream will tell you, it'll give you a lot of pretty accurate information on all of this stuff. Actually, we use it all the time. And like I said, it is important to know your market rents. If you rely on Zillow, for example, for any of these, they're pretty far off with a lot of these. They'll give you in the ballpark, but they're always in the market rents. Like if a typical market rent is $1,000 in that area, they'll add like $200 to it. So if I look at the Zillow market rents, I always subtract $200 to whatever that number is. It's a basis to look at, because we we run the properties with on those sort of things. Plus we do a little bit of everything to try to figure out the numbers and get as accurate as we can. And as far as rehab costs, they're going to be ever changing. As the market's changing, the rehab costs are going to be more, and sometimes they'll be less if the materials and the demand is down. Then the rehab costs will go down. And know your area with the zoning, the schools, the crime rates, that sort of thing, because it's going to cost you extra money for like flood zones. You have to compensate for that. You're going to have to get flood insurance, especially if you get a loan or money lender. They're going to want insurance on the house, and especially in the coastal areas, that's going to run maybe $100 or $2 more a month when you save for flood insurance. So it adds up quickly. So always err on the side of caution and be conservative. And then taxes, insurance, same thing. And you want to, for the insurance, you always want to, shop around, talk, call different insurance companies. And see, cash. Looking at my notes here to make sure I didn't miss something. Okay. You got anything else? And one thing, ignoring the location. Oftentimes people don't look at the locations and the areas. We always look at, especially, well, it doesn't matter for flips or rentals or whatnot. You're going to get higher rents and higher price for your houses when they're in the good school zones, good school districts. There's a area in Tampa where if you're in the schools district, one of the districts, like it has one of the highest schools in the state, and your ARV for that house is going to be a lot higher in that area. So if you're pulling comps and your house isn't in that area, the comps are going to be skewed. So you want to look at the location, you want to look at the crime rates. You're going to have better quality renters with areas where the crime rates aren't as high. You kind of like Jane and I look at it, where if we want to live there, then if it's good enough for us to live there, it's good enough for the tenants. You don't want those war zone areas. And the economy, see how the economy's swinging right now with the rent rates that were going sky high from the market that was so high. Now it's coming back down and people can't afford those rents. The rents. So we never did jump on that bandwagon and raise our rents all the way to the top of the bracket. We kept it manageable and reasonable. And now people are going to see, the landlords are going to see where they have it cushioned in, where they raise their rents periodically, yearly. They're not going to really have that that ability to raise their rents because they're already too high. So you're looking at, the economy there and the future plans and potential. We do look at that. We look at the, the jobs in the area, what looks like things are going to come into the area, and the potential plans that does go into effect, but sometimes don't count on it. Yeah. Sometimes they'll be expecting something to happen in the area and then they'll change their mind. So, don't put all your eggs in that basket, but it's good to see. and how it's going, whether, things are coming in, industry's coming in, it's looking like it's upticking. And let's see, I haven't been using my notes for now. And underestimating costs, like repairs, maintenance, property management fees, taxes, and insurance. I was actually working with an investor who wanted to do owner financing on her house. And she wanted to put a family in there on owner financing. And they wanted to use a servicing company. And we were helping her out, getting, doing all the paperwork and the contracts and making sure that she understood how to do it. And, just the little things like adding $25 to the payment so that it does pay for the servicing fee, and that you still have to pay onboarding fees. You got to look at, the servicing companies and how much they charge for different things. Just the onboards, sometimes at what, $500 the onboard?
1,500.
500 to 1,500 just to onboard. And then you're going to pay $25 a month per house. So it gets costly. You wouldn't think it costs that much, but it's and property management too. You want to vet your property managers. You want to get a list of, price lists, because they charge 8 to 10%. If you have more properties, the more properties you have with them, the lower the percentage that they're going to charge. But typically average is 10%, but that's just if everything's running smoothly. If they have to, sometimes placing the tenant, they charge extra. For screening the tenant, they're going to charge extra. If they have to do eviction process and go to court, all that is extra costs. And taxes, as you know, taxes and insurance go up yearly, it seems. So you just have to, make sure you add a cushion and don't underestimate any cost and think you can catch up, because then it just continues to snowball. And you want to have like a detailed budget for yourself, like an Excel spreadsheet. It includes all the expenses and the potential expenses, the mortgage payments, the property taxes, rents, insurance, maintenance, repairs, management fees. And you want to regularly update, periodically review and adjust your budget based on how the expenses are increasing or decreasing, hopefully decreasing, but usually it's the opposite, they're increasing.
And that was one thing that really got away from people in Florida, was they weren't really paying attention to the insurance and taxes as rentals, and they were creeping up a little bit. And then after the hurricane, they really like this doubled, tripled sometimes. And a lot of people got stuck with, now they're negative cash flow because of the insurance and taxes went up and they weren't really paying attention.
We found that out pretty quickly when we had a rental in like an hour south of us, and that's where the hurricane hit. And pretty quickly we realized that the insurance is, going to go up pretty quickly. So we switched that over to putting a family in on owner financing. So always want to be thinking and strategizing for when things happen so that you're not hurt, you don't get hurt. Let me see. Failing to diversify, putting all the investment capital into a single property or market. That increases your risks. And diversify your portfolio by investing in different types of properties and locations. That's, like I was talking before about short and midterm rentals. That's it's another thing. Not only do all your capital into one market area, but also having investing in one type of investment, especially with these single family homes. You don't want to have all short-term rentals or all midterm rentals. We do a little bit of everything. We do from short-term rentals, regular market rents, flips, owner finance, lease options. And then we also take it a step further by going into different states. So we really diversify and have properties everywhere, but you might not want to go to that extent, especially being new, but you don't want to, we've seen people get into so much trouble by only knowing one way to do things and investing in one type of market, and they've gotten themselves in trouble. And believing in that real estate investing is a get rich quick endeavor. A lot of these gurus out there, promise you get rich quick. You're going to get in there and make all this money and, have to be able to quit your job and be financially set for life. You're playing the long-term game. You don't, you have a long-term strategy. You want to develop an investment strategy with goals, timelines, exit strategies. And you want to have patience. You don't want to rush things. Understanding that real estate investing typically yields the best returns over the long run, over the term. And you want to be very patient and avoid impulsive decisions. Of trying to get rich quick, you're going to buy a property that's, the numbers aren't completely there and force a deal to work. And, this mentality where these gurus, they just want you to buy their $50,000 and $80,000 courses. They're just, with the promise that you do this and you'll make money quickly. And then, you want to be on top of your game and think you just have to go out there and buy all these houses. And then that's when you're really going to get hurt. That's not a good thought, a good development at all. Yeah. Okay. It was a quick overview. I'm sure we could probably think of some more, but thank you. And maybe we can talk about if anybody has any, thing they want to work, go over, or look at, and make sure you aren't making the mistake before it happens. And that's what's important too, is, networking like we're doing here. It's a safe place for us to look at our deals and go over things so that you don't make these big mistakes. And I can stop sharing. So, okay.
I just have one other probably big one for us. Handshake deals and JV agreements, and just make sure that is very specific, no matter who it is. It can be family, friend, somebody you don't even know, but make sure the paperwork is very specific as to what each person expects, what each person will get out of the deal, when, times, if it's a year, 2 years, whatever, what happens if it doesn't, because everybody starts out and it's the honeymoon period. And, this can be anything, just within a JV agreement when something goes south, or a company or a partnership. So make sure that, you have paperwork on all expectations from every side, and make sure it's very detailed and not just vague for interpretation.
Exactly. And no matter how long you work with somebody, make sure you always check, make sure that things are going the way you think they're going. Because it can happen quickly. People are out there, predators, and they'll get your, they'll start working with you and gain your confidence, and you trust them and like them, and then all of a sudden, then that's when they strike, unfortunately.
It's very true.
And make sure you're always secure. All your, everything you do is you have secure, it's on contracts, it's written down, it's secure. And if you have like we made a mistake of going into the RIA group right away and telling people that we had a self-directed IRA, and then people are coming at us like vultures and trying to talk us into doing unsecured loans.
Well, not trying.
Yeah, they got us.
We were talked into several unsecured with the promise of this, because
paying it back.
And we thought they were, the big deal in the RIAs, so.
Trust but verify.
It's a pretty small crowd, so if anybody has any stories or other mistakes or things to avoid, landmines.
Or any other questions.
I would tell you stories, but we'd be here all night of mistakes that I have also made.
Emma, do you have something?
I was just thinking that sometimes you get emotionally involved when you make a decision, when you maybe miss important information about property just because you might like it a lot for a reason or another. So trying to keep the emotions to the side sometimes is hard.
That's a great point. A lot of us do that. We'll fall in love with the property or the deal and we're try to force it to work. That's a great point.
I think something that you guys brought up, which kind of dovetails really nicely into what Emma just talked about, is that, this really is a long-term business, so if you are looking at a deal and falling in love with it and you're like, something, I need to hop on this now because, I won't get another one or whatever it is, then you're really not thinking long-term, right? So if you're thinking long-term and go, well, something, this one isn't quite right. I really like it or whatever it is, but that's okay. I'll just keep working. And because I'm in this business for the long term, something else will come along. There's a couple of sayings out there that the best deal is the one sometimes that you just walk away from. Or good deals are like buses. If you wait long enough, another one, comes down the line pretty soon and consistently. But again, really, really, and this is what I try to encourage people to do. And it's unfortunate because I think a lot of people get into a situation in their lives for whatever reason, where all of a sudden they have to make money now, right? And those people unfortunately get caught up in the, hey, something, you'll make X amount of dollars in the next, 90 days. And because you're so desperate for money, we're going to charge you $50,000 for this 1-year mentoring program or something like that. And people get really, really caught up in it, so I guess my encouragement for everybody, no matter what age you are, no matter when you're starting, is to really get started now, because it does take a little time to create actual wealth, not just, cash chunks. And time is your friend. But if you wait a very long time, you've got all that time that has gone by that you could have been working on your business, and created a consistent, whatever you want to do. For me, it's cash flow. So a consistent passive cash flow. But really, I mean, if I could encourage anybody to do anything is, something, no matter at what level you're at, get started on something now. Don't wait. Everyone says, oh, it's a bad time. Interest rates are too high and stuff like that. You look at someone like Jane and Sharon that have done so many different types of deals. And I think to them, and correct me if I'm wrong, but to them, I think the market really doesn't matter. You can make money in any market. You just have to have the right strategy and you have to play for the long game. I mean, would that be accurate, Sharon, Jane?
Yeah, absolutely. It seems like we're so conservative that we actually seem to do better when the market's not as hot because people are buying properties close to ARV and all, and we step back. And then when the market starts settling down is, when we shine, so to speak.
Got to be patient.
Yes. Because there was some, with the market hot, a lot of people make mistakes too. And that's big mistakes because they're overpaying for the property. And then you never know when it's going to downswing or, where they had problems with, flipping a house and paying top of the market for it. And then you had issues with getting the materials and everything on hold. And then by the time they were able to purchase the materials and everything wasn't locked in, then the market started turning the other direction. And then they're stuck holding this expensive house that's not worth what they thought it would be worth.
Right.
And people were doing that. We noticed a lot with the high dollar houses. Like we didn't jump to, going to the high dollar houses. We like to stick with the houses where the majority of the people want to, are going to buy. So we have increased our buyer pool. People were jumping to these like luxury high dollar houses when the market was hot. So you have a lesser of a buyer pool. And then when the market goes down, then you have even less options. And then it's going to be higher holding costs and you get in a lot of trouble that way.
Absolutely.
So, stick with the plan. Don't try to change because the market, try to do other things because the market's shifted. We stuck with what we knew and buying the same way. And, we did less in the hot market, but then we didn't get hurt either with the people that, other people that we saw that got hurt. Would you wanna? You're quite quiet.
Jane is very quiet today. There was actually an article. I don't know if you guys ever get a chance to read the Wall Street Journal. You can actually get some of these deals, like you pay $50 for the entire year. It's really, really well done. I've been reading that for a couple of years, and what I like about it is it's very unbiased. It's like, here's the information, you're an adult, you make the decision kind of thing, which unfortunately I wasn't able to get that kind of stuff in a lot of different places. So anyway, so I read a lot of articles in that thing, and one of the articles they came out with was talking about during this crazy time during multifamily, where the prices were so crazy that a lot of people not only were overpaying, but they were sending in T12s and projections to the lenders that were more than what the actual property was doing currently, so they could get the loan and get the property. And now, as a lot of you know, a lot of people overpaid. Now they're in a lot of trouble because they can't refi out and stuff like that. But one step further than that is a lot of these people that did this, unfortunately, for the most part, most lenders don't ask for any kind of audited books. It's like, need to get a CPA to, confirm that all these numbers are right and stuff like that. They kind of, for the most part, take you at your word in terms of what it is. Because it's just very hectic to try and get audited stuff. And you may see that coming now because a lot of these people, it's something incredible, like 5 or 10% of all loans that were repackaged multifamily and sent back out into the market are coming back because the numbers that were sent in by the buyers were overly inflated. And now what they're doing is not only are they going back to these individuals and if they can prove it, right, basically cutting them out. You will never, ever get a loan, from Fannie Mae or Freddie Mac or any of these lenders ever again. The SEC will also tell you will never, ever be able to syndicate. And for some of these really egregious people, they're actually going after them with criminal charges, saying, what you did was fraud. It's bank fraud. Right? You got money that now you're going to lose based on some numbers that you totally made up. So there is some, it's not like nobody was hurt. Somebody got hurt, therefore we're going to come after you. So, we'll see what happens over the next, 5 or 6 months or whatever it is. But it all goes back to what you guys were talking about. If you think about it for the long term, if it works now, is it going to work in 5 years? Will the property still be worth what it needs to be in 5 years? What happens when they need to refinance? What happens if the market tanks? What happens if this happens? If you really plan like Jane and Sharon do and Nicole and I, do as well, you can do really, really well, but you really have to get out of the get rich quick mentality because you are almost guaranteed to get burned at some point along the way. And it's painful. You can lose a lot of money. So
Yes. We've made mistakes and lost money, but thank goodness we didn't make the huge mistakes where we lost too much money and then we were out, like I said, out of the game, and then you can't get back in. There's so many investors that'll do that and then they stop investing.
right. No,
We were just on another meeting before this one, and I think the guy's sitting on, he was liquid like 12 million, and he's picking up 3 different multifamilies. I want to say in Texas, but I'm not sure. 3 different things, one for 2 million because they way overshot everything. So one for 2 million, one for 5, and then whatever's another 5 million. But he's getting 3 pretty good deals, pretty sweet, because they were going to foreclosure or going to wherever, and he was just sitting 12 million liquid, and he's just waiting for the deals to come in.
Yep, absolutely.
We did notice that some of our real estate groups, the ones that's been doing it for years, they were stockpiling money, waiting for the multifamilies right now to start, come due.
And the wholesalers are kind of disappearing. Like, you had millions of them in your inbox, and now there's very few because they could sell a bologna sandwich for $100,000, and now they can't.
Very true. Anybody have any questions or thoughts or
Stories?
Yeah,
Their own
stories are always good.
stories?
I guess I'll ask a question. More for like multifamily, like when choosing a market to invest in multifamily, you read all these articles and reports about the emerging markets, like the secondary and the tertiaries in the entire US. So there are a lot of good markets. So even from those reports, how do you like pinpoint your like 2-3 markets which you wanna go after? Do you value the proximity? Hey, it's like closer to me, so I can, maybe it's like 3-4 hour away, I can drive by if there's a big property coming up. So yeah, how do you pay? Yeah, just choose from that.
I mean, I can only talk to, multifamily, and Jan and Sharon can hop in here because they have stuff in a lot of different states for single family, but, and this, it's gonna be a short answer because that's like, when you take the course, it's like 3 hours, right, on how to pick your market, right? So it'll be a short one, but basically we usually recommend is that you, and there's different ways to choose them, but when you do end up choosing them, that you end up with about 3 markets, right? Because what ends up happening is that if you are kind of all over the place, right? And let's say where do you live now?
I live in North Carolina.
Okay, so you live in North Carolina, and let's say you get a deal in Columbus, Ohio, right? But your markets are down there, right? So when they send you a deal, now all of a sudden you're like, all right, now I got to find out about the market. I got to find out if this is a good area. I've got to find out if the per door price is right. I got to find out about rent and stuff like that, right? So kind of you're hopping all over the place, and that takes time, and good deals don't last very long, right? As opposed to, right? Not to say you can't look at that, but maybe a better direction might be to say, something, I'm going to pick 3 markets, and you may start with 6 and kind of cull it down, right? It's totally up to you, but we really recommend try and keep it to 3 markets, right? One within a couple hour drive of where you live, right? If you live there for a while, you know the area, right? You know what a good area is, what a bad area is, and you could do more research, on government websites and stuff like that. But for the most part, like I live in Ellicott City, Maryland, and grew up overseas, but spent a long time here. So I know kind of the Maryland area pretty well, Maryland, DC, Northern Virginia. So I know that area, but then, maybe a place where you used to live, maybe you used to live in, I don't know, Atlanta or something like that. You went to school in Atlanta, or you have family in Atlanta, somewhere where you have boots on the ground or some knowledge, if you will. And that, something, if I have to, I can hop on a plane, I can be in Atlanta in a couple hours, or I can drive 4 hours or whatever it is. So then you've got that second market, right? And then your third market, you can be wherever you want, right? Kind of you can do, throw a dart, or whatever you want to do. Everyone is very different. Some people I've spoken to is like, if I can get on a flight and be there in 2 hours or less, that's my window, right? For me, I'm tired of getting on a plane. And by the time you figure out 2 hours to get there, then you have to board, then you have to fly, then you have to get a car and all the other stuff. So for me, it's kind of a 4 to 5 hour drive from where I live. So I can leave at 4 in the morning, be there at 9, be there the whole day, get back in the car at, 6 or 7, be back in bed by 1 or 2 o'clock in the morning. For me personally, right? That works for me. That's kind of my outside circumference. Now, people have been sending me stuff in Columbus, Ohio, right? I don't know what's going on, but I've been getting a lot of that, and that's like 6 hours. So I'm like, oh, do I really want to drive that far? Kind of thing. So, it's a personal choice. The one thing I would caution you against is that if a market, right, sometimes, not always, but sometimes, if a market pops up and a lot of people are talking about it, and it's an emerging market, and you see it on 17 different lists on the internet, chances are most people already know about it, so it's driving the prices up, right?
Yeah.
We have a great deal of success in secondary and tertiary markets. A lot of people don't like tertiary markets because, the populations are smaller, 50, 60, 70,000 people, whatever it is. Idaho Falls has about 60,000 people, and they're the number 3 market, I think, in the country, and they're a tertiary market, right? So you never know. So I would not, well, you have to feel comfortable enough to go out to a tertiary market, know it well enough, and make sure you can find good property management. That's key, right? Job 1, property management, right? If we can't find a good property management company, we will walk away from the deal. But yeah, just, pick 3, evaluate them, and then just run with it. So,
Right.
hopefully
No.
that helps a little bit.
No. Yeah, it was a great answer, because like on that same point, I saw in a lot of reports that in like North Carolina, like Raleigh, it's like very emerging. It was on like the number 2 in the job growth and everything, but everyone knows about it, and everyone is like hunting the deals in that area. So yeah, that makes sense.
Yeah, I like Raleigh. Raleigh's 4.5 hours because I've been there several times, but you're right. It's a little overpriced and I'm very cheap.
Okay.
And now
Thank
we
you,
actually
Aaron.
have, we know flipper friends in Raleigh and their Days on Market. Like they put out a beautiful product and Days on Market are longer and it's overpriced now. So things are sitting there a little bit for single family space.
Okay. Yeah, makes sense.
Jen and Sharon, you guys are in a bunch of different markets. You want to speak a little to that?
Yeah, I mean, I think for us, it kind of came out of us moving to Florida while we were in Maryland. So we had a good amount of people in Maryland, then we had people in Florida. And then just, your network is, if you're in a group with people from all over the place, you have boots on the ground. So, and we noticed, Gary, Indiana is, one of our markets, but when we got in there, we got in early, so we could pick up houses for 10 to 20,000. Now you can't touch them for 50 to 60. So do the numbers make sense with the risk reward? Whatever. I mean, we can still probably flip in there a little bit, but even those numbers are getting tighter with, no room for error or mistakes or whatever, because everybody decided that was a great market and they flooded the market. So we have a great team there. But that's another thing, as your team gets busier with local people, then they might not have as much time for you. So we learned that in the Baltimore market, people get busier and then, you're not there driving by every day or, on site. So then, okay, well, I'll get to that at the end of the week and then it never comes. And then you're 3 weeks behind in your project because they're dealing with the local people. But, as long as you have good boots on the ground and you keep on task with, if they start slipping a little bit, if your team's slipping, don't take the excuses and, see what's going on. And if it's something that, they got busier with other people, then it's time to either find a new team or, find a different market. But, we're like James and Nicole. We like that. We don't like the busy cities. We don't like the, places that are the hot topic, the hot market or whatever. We look for the outskirts and places where other people aren't. There's less competition. There's more, and everybody needs a place to live. So depending on what product you're doing, whether it's rental, a lease option, something creative, then I think that's where you score. And even I would say in multifamily too, probably looking for those creative options in markets that other people don't want to be in. That's where you're gonna score a better product.
Right. Yep, makes sense. No, I appreciate the answer.
Don't be afraid to be creative on deals like 100 doors and less. We've sent out some pretty creative deals and gotten into best and final on several of them that were very creative, right? So it seems to be more acceptable now for some kind of those smaller, 100 units is not small, but below that, this seems to be a little bit more accepted because some of the bigger guys are doing it as well. One of the things that just kind of go, I just want to make sure I touch on this because there was something a little different, but in terms of what Jane and Sharon were talking about before, so in terms of getting stuff in writing, right? So not specifically for you, but for anybody, right? So money just changes people, whether it's you're making money or you're losing money, either way, it changes people, right? And stuff that was, to put it in Jane's words, kind of a honeymoon phase, everything's fantastic, all is going right or whatever it is. Then something happens and all of a sudden it's like, oh, I thought you were going to pay for it. And it's like, well, why should I pay for it? And, I've been down this road 3 separate times and been burned 3 times. So, trust, but verify. I think it's great to get anything that you end up doing in writing as soon as possible. If you have friends and stuff like that you're doing stuff with, it's even more important to get it in writing because at the end of the day, the friendship is the most important thing. and you don't want to get money, in there and screw it up. So if you're friends, you're like, okay, let's just write it out. We've all got it. And then if something good happens, great. Something bad happens, too bad, but at least you've got it in writing and you keep the friendship, which at the end of the day is the most important thing. But yeah, absolutely get it in writing. I couldn't agree with Jane and Sharon more on that.
I see.
We did learn that, like with partnerships, we would rather do like JV partnerships, like joint venture, like one project at a time, instead of just like merging companies together, like maybe one multifamily at a time or one house or what have you. Keeps it cleaner. And then once that project's done, then that joint venture agreement's complete. And then you can go on to the next one. We've done it both ways, and that way seems, we're more comfortable with it. It seems like there's a lot less headaches and issues that arise. I don't know if that's what you've noticed too, James.
No, absolutely. And I mean, Joanna and the guys can basically attest to this, that I've told everybody just what you're saying basically is like, something, do one deal first. Because if you've known these people for a long time and they're friends and stuff like that, you need to get in writing anyway, right? Just because, it's money changes people, like I said. But specifically, if you don't know people, right? You do one deal and, everything is hunky-dory in the beginning. And, part of what we've discovered is that, Jane and Sharon and myself and, a lot of the people on this call are very, very hard workers, right? We do what we say what we do. We just grind it out, whatever it takes kind of thing. And unfortunately, sometimes when you get into a deal, you find out that somebody is like, oh, well, I don't want to do any more work. I'll still keep taking the checks, but I don't want to do any more work, kind of
Right.
thing. So if you only have one deal, it can be, okay, great. We'll get through this deal and then we're done. I'll go find somebody else or whatever it is, but it just keeps you safe, as opposed to, starting an LLC together, you're not sure about them and stuff like that. So.
Yeah, exactly. And like that actually, I mean, I did not lose any money, but like I actually because like I like constantly look to find good motivated people I can like partner with. So I had a guy, we talked extensively about our goals and everything, and then we sort of made an LLC, made the operating agreement and everything. So after that, the communication was so less. I wanted to communicate more throughout the week so that we can have like the right accountability and like what to do in the entire week. And he wanted to communicate just like once a month, and then I'm like, once a month we cannot invest in heels. So it
Right.
just ended up not going right. So
Yeah. So, well, I'm sorry you spent money on the operating agreement and the LLC, but at least you found out early, right?
Yeah.
And you're absolutely right. I think, if someone's building a business and they only want to talk to you once a month, that's a pretty big flag. And over communication is always better than under communication, better to go, oh, okay, he called me like 4 times in the last week. That's okay. Better than, gosh, I haven't heard from this guy in 3 weeks. I wonder how the project's going. That you don't want that, right?
yeah. He was like expecting me to work in the acquisitions by myself and just talk to him when I have a deal. So
Right.
I'm like, yeah, so that wasn't
Yeah. So
okay.
yeah.
And sometimes it's just you can be friends and you can, go out and do stuff on the outside, friendship, that kind of stuff. But when you get to work, it's a different thing, and it can be as much as right brain, left brain. I mean, I know I drive left brain people crazy because like numbers, whatever, it works, da da da, go 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 go. And left brain people are no, I want to sit down and look at the numbers. I want to go through every number. I want to get my calculator out. So, just those kind of things. And, sometimes you need a left brain and a right brain on the same team, for those benefits. But, or it's just personality, how people treat other people. If you're working with somebody and they're, shitty to your contractor and crappy to everybody around you, and that's not the way that's not the way we operate, then I don't want to be associated with somebody that, now you're in a partnership with them and you have a company together, and then now that's how you're perceived.
So like, do you like recommend partnering with people who can like strengthen what you are weak at.
Yes.
I'd say if I'm not good at raising money, so should I look for someone who is more like personable, who likes to go to the networking events and everything, and he has a good sense of the conversation skills and and maybe with like a sales background or something like that.
Yeah,
Okay.
sure.
I think that would be great. Yeah, like, somebody that, there's a book called Traction, and it basically talks about like an organization or team where you put the right person in the right position. So it's good to have, diversity where, you have somebody that is good at what you're not good at, so that, that you can expand and grow faster. So I think that's great. And like Jane was saying, the right brain, left brain, the right brain wants to go and do all the deals and networking, and the left brain wants to be analytical, and the two together is a great combination. I had to force myself to do the numbers and stuff. Both of us are a little on the right brain side. So.
Yeah, even as something as simple as reading a contract. You need somebody in your group to read the contract. Personally, I get through the first paragraph and I'm bored, so.
She throws it at me.
And so Sharon has to read all the word by word, because that's just not my thing. And then we would miss something. So you have to have somebody that's strong in the things that you aren't.
I see.
And practice too. You want to practice getting better at the things you're weaker at. Like I had to practice to learn, to be more analytical and to, crunch the numbers quicker and more easily and be efficient that way, because I was, very right-brained, and now I'm kind of more in the middle, so it balances out. So it's absolutely right. You train yourself to be good at the things you're not, and get other people in your team to help out and do what you don't like to do or you're not as good at. But try to learn everything on your own too, so that you do know how to do it.
I see.
All right, so wow, it seems like the hour went by really, really fast.
It did. Oh my goodness.
7:31. Anybody else have any questions, comments, suggestions for the next presentation, things you'd like to learn about? Anybody got any
Maybe
questions?
I don't know if you have already talked about this, but maybe like broker relationships. I think that we have already talked about in the past. I think I saw the video on the
Right.
YouTube. But like maybe how to get the list of like brokers in a new area you wanna invest in.
All right, so there's just some strategies on if you're going into a new market, how to identify good brokers, how to start a relationship with them, that kind of thing.
Yeah, yeah, and like how often do you like follow up with them? Of course, you don't want to bother them
Right.
every single day.
Right. So I'm gonna leave you with one thing, okay? So I can leave you with a lot of stuff, but just based on what you said, right? So a lot of people, like with banks, right? They're like, oh my gosh, I've got to do whatever I can to get this bank or this lender, whatever it is, to give me the loan, right? They don't make any money unless they give you the loan, right? They're selling a product. You are the purchaser. Now, there are certain parameters that allow you to be the successful purchaser. So I always encourage people, don't look at it as confrontational, look at it more as working together, right? A lender is going to be your biggest partner, right? And the same thing with brokers. When you talk about you don't want to bother them too much and stuff like that, if you don't bother them, they can't sell anything and they can't feed their family, right? So, granted, you're not calling them every day or whatever it is, but there's that balance, they want to hear from you, you want to hear from them or whatever it is. You just have to find out what that balance is for each specific person, because you have to work together with them to be able to do it. They don't, it's not you against them, it's you guys working together. So.
Gotcha. Yeah.
Awesome.
It makes sense. Yeah.
All right. So anything else? Anybody?
No, cool. Thanks for being here. Appreciate everybody's time.
All right, guys, we'll talk to you soon.
Thank you.
Good night.
It was great. Good night.
Good
Thank
Good
night.
night, Emma. See ya.
Thank you.
Bye.
Bye.
Okay.